Hi, everyone. This is Jason Barrick of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's a true expert on the oil and natural gas markets. He is the chief investment officer of Bison Interests, which is a hedge fund that invests in publicly traded oil and natural gas companies, mostly in the US and Canada. Josh Young, thank you for joining me again.
Yeah, thanks for having me back.
So, Josh, we're recording this interview on Friday, July 26, 2024. West Texas Intermediate price has been stuck in a trading range in the mid to high 70s. It's at $76.79 right now. The U.S. natural gas price, it's just collapsed again after a rally over the last 6 to 8 months. It's collapsed again back to around 2. I want to get your thoughts first, though, on the upcoming November elections. And if you think that the politicians, both parties, because it seems that both parties are worried that a higher oil price will start to affect the swing voter. So the person who maybe hasn't decided yet who they're going to vote for. And do you think that the oil prices, the politicians pay attention to a higher oil price and how that will affect inflationary expectations and the consumer price index?
Yeah, I think a lot of the sort of political understanding of this is driven by two things. One is an old understanding of how the economics work for oil versus the U.S. economy, which is dated and no longer true, and was from when the U.S. used to be a large importer of oil, which was that higher oil prices were bad for the U.S. economy and lower oil prices were good. Quite obviously, to anyone that's taken Econ 101 on the macro side and knows that, if you're a net exporter of something and the price goes up, your GDP goes up. And if you're a net importer of something and the price goes up, your GDP goes down. It's just a balance of payments calculation. And so, on, for whatever reason, both parties have decided to stick with this wrong economic understanding of oil price. One of the easy explanations is that gasoline prices are very publicly displayed. They're probably the single most public displayed price of anything that's sort of consumer facing, or maybe anything in the economy. And so, people notice when gasoline prices go up or down. And so you end up, I think, having policymakers and politicians really working hard to have low gasoline prices when, again, as a net exporter of oil and NGLs and various other hydrocarbons, we should actually want prices to be higher. And with a very small amount of education, along with maybe a reduction of gasoline taxes replaced by other taxes, or maybe not replaced by other taxes, you could actually have lower gasoline prices if you reduce regulations, reduce gas taxes, and actually have a much healthier fundamental U.S. economy.
And you mentioned also that it seems that the Biden administration, they didn't care where the new supply was coming from, but the goal was to bring more supply online, oil supply online as quickly as possible. And you mentioned that they gave enormous waivers, to Iran and Venezuela?
Yeah, we were talking about that before we hit record. It's like we're over 1 million barrels a day more exports from Iran right now than we were at a few years ago. And then Venezuela, it looks like their oil exports have grown by over 500,000 barrels a day. And sort of an aggregate between the two, as well as some slippage on Russian sanctions and so on, we might be close to 2 million barrels a day of additional supply through essentially lax sanction enforcement by the Biden administration and their allies. And it's sort of this sort of nihilistic, astonishingly poor economic policy where it's like beggaring the people of the US, and there's all kinds of economic statistics that look bad and are getting worse. And then they'll lie to everyone, blame other people, and then get this production on in Venezuela and in Iran and money into the pockets of these despotic and, in the Iranian case, theocratic dictators that pursue policies that are sort of the opposite of some of the social policies and other stuff that the Biden administration and potentially Kamala, Harris administration are pursuing. So it's a very, very strange, very nihilistic, and very sort of uneducated, or sort of intentionally dumb policy where they're just ignoring the most simple economic calculation, which is if you make more than you use of something and the price of it goes up, you're better off. So again, just so stupid And we've put together a white paper. We're probably going to put it out soon on this, using some very formal economic analysis as well as some informal observations and charts and so on. And it's just ridiculous that this is a talking point. And then it's also, I think, very disappointing. I think I've been accused of being partisan, and the reality is that the Trump administration or the Trump, campaign or whatever, they're still talking about lowering gasoline prices too. And yeah, I think like producing oil in the U.S. versus Iran is a good economic policy, but it's still wrong to think that lower oil prices are good when you're a net exporter of oil. It's just wrong. And again, I don't know whether it's more disappointing for one side or the other to get this wrong, but both of them are getting it substantially wrong. And I'm sure that will win me and maybe us no love for highlighting that. But it's one of those things where it's like both parties are like sort of cooperating to make Americans' lives less prosperous and more miserable through perpetuating a misunderstanding of something pretty simple.
And I would also argue that especially with energy policies here in the United States, there's an enormous amount of hypocrisy and NIMBYism, not in my backyardism, where if the energy policy is allowed in another country, the people, the environmentalists and stuff, like they really don't care as long as it fits a political end. And we see this with the Paris Climate Accords, where China and India, which do a lot of manufacturing for the global economy, they get all these exemptions. Coal demand just hit a record high, I think, for electricity power in 2023. It's still going parabolic. So all the fossil fuel demand is going enormous. Is still increasing enormously in China and India. Meanwhile, like you have the environmentalists on TV talking about restrictions, but they're funding all these electric vehicle companies, and the electric vehicle companies, most of them in the US and Europe, are close to either bankruptcy or they are going to need bailout soon.
Was that a statement or a question? Because I agree with that, but it's a good observation.
Well, I was just going to bring up also that they basically have hampered. Sorry, I was just making a statement here, but the question then is, do you think then if Trump wins the election that he could start removing some of the blockages for the permitting and there would be an increase in drilling then on some of the federal lands? Would there be more oil and natural gas drilling fairly quickly?
Yeah, I think there's a reasonable expectation that the drilling rig count would rise under if Trump wins, both because of federal permits and because there would be, I think, a reasonable expectation of a normalization of regulatory and tax practices, where the Biden administration, similar to the Obama administration previously, has very, very onerous regulations and taxes, and so it's very tough to be productive if you have to spend your time dealing with unforgiving regulator and getting sort of nickeled and dimed on the tax side, and so. I think a pullback to the extent that Trump in administration 2, to the extent that happens, goes ahead and does a similar regulatory rollback as he did in Trump administration 1, I would expect substantially more drilling activity, similar to substantially more factory construction, substantially more onshoring of various other things, more chemical plants, and so on. And so I think there's sort of this misconception that will lead to a crash in the price of oil. I don't think that's necessarily true. I think people are noticing sort of a coincidence, which is that Trump got in power right as the Delaware Basin in the US and the Permian was starting to really ramp up. And you saw for a few years, 1 to 2 million barrels a day a year of supply come on. And a little bit of that was from the normalization of taxes and regulation. But a lot of that was just from there having been this large oil discovery in the US. And there's not really anything like that right now in the US. And so it seems pretty unlikely that you'd see anywhere close to that amount of oil coming on. I think it would be pretty bearish for natural gas, because I think you'd see a lot more natural gas come on soon. And it would take a little while longer for more LNG export facilities and chemical plants and so on to come on, and for there to be more factory activity and so on to absorb that natural gas production. But on the oil side, I just don't see it. I think you'll see more drilling activity, but not a lot more oil production. And then any incremental oil production, I would expect to get offset pretty quickly through sanctions and frankly, just enforcement of existing laws and existing sanctions against Venezuela and Iran, who are essentially public sworn enemies and who, at least in Iran's case, are funding military groups and terrorist groups that are attacking the US and other sort of U.S. ally interests right now.
Yeah, I agree with your assessment of natural gas and liquefied natural gas. I think by early to mid 2030s, there's going to be a lot more liquefied natural gas export facilities online. There's quite a few under construction. There was a buyout of one recently by Woodside Petroleum, the Australian company, to restart another one that already had a permit because it was a small cap and they didn't have the ability to use debt financing anymore. And then if Trump does win the election, I mean, I think we'll see a lot more liquefied natural gas export facilities permitted because basically would you say that liquefied natural gas plants are arbitrage? So they take the cheap natural gas here in the US and then they turn it into liquefied natural gas once it's moved to the pipeline and export facility and then it's sold at a much higher price in another market in Asia or Europe.
Yeah, I think that's the right way to think about it.
I want to ask you about the Strategic Petroleum Reserve. Are they still dumping Strategic Petroleum Reserve oil onto the market, or are they not? Is it about flat lately?
So the oil SPR has actually increased a little. I think I saw some stats where they were saying, oh, it's like one of the biggest refills of the SPR in any given year. But I think people forget that there was a large oil supply surplus in the late 80s and early 90s. And even I think in the early 80s where you saw a substantial build in the SPR, but that was sort of in a different oil market. The current oil market is much more balanced to potentially undersupplied. And so even this small add to the SPR is meaningful. The Biden administration did follow through on closing a smaller gasoline reserve on the East Coast. And, I've seen various sort of apologists for both selling the oil out of the SPR, which the Biden administration did not this year, but last year and the year before. And those same apologists are very forgiving of closing this gasoline reserve. I think it's just frankly stupid. And it's one of those things where, if you cancel your homeowner's insurance, let's say you cancel your hurricane insurance in Texas, and in the first year there's no hurricane, so you look like a hero because you didn't pay the premiums. But then in the second year there's a hurricane and your house gets destroyed when you have no hurricane insurance, and FEMA doesn't cover it or whatever for whatever reason, and so you're gone. You lost your whole house, and so it's a catastrophic loss. And so similarly, the SPR isn't there to help politicians win elections, regardless of the party. That's not what it's there for. It's there for there being a substantial supply shock. And, I actually am somewhat forgiving of the SPR release in 2022 around Russia's invasion of Ukraine. I think that is a sort of circumstance where there was at least a risk of a material supply shock. And so that was a circumstance where it made sense to accelerate selling off oil in the SPR. And then there's these arguments around, oh, well, the US now is a net producer rather than a net consumer. And while it is true, the US is also set up to be able to store a lot more oil than our allies. And there is a strategic aspect to the SPR that's not just US centric, and then also helps balance out various crude grades that are necessary for our refineries, where even if we're a net producer of oil, we might not produce enough net for our local refineries. We both export and import large amounts of oil. And so there's substantial strategic value still for the SPR. So again, I think apologists sort of mess up on that. I think it's just really simple. It's as a form of insurance. It's actually very, very cheap to administer. And if you look at history, the value of having energy reserves, I think, can't be overstated.
Yeah, I would agree that the Strategic Petroleum Reserve over the last 15, 20 years, it's turned into a political tool to try to help either congressional elections or presidential elections. I think they're monitoring what the consumer price index, because the oil price makes up a pretty large component. So if there is an oil price spike, it tends to lead to a spike in the consumer price index, CPI spike. So I think they dump the oil from the SPR as a political tool to try to manage the CPI before an election now.
Yeah, no argument there. It's really unfortunate. It's something that is important and necessary. And again, like, you shouldn't really mess with your homeowner's insurance. You shouldn't really mess with your auto insurance in order to balance your monthly personal budget. And in the same way, I think it's sort of been this big mistake where we were sort of saving for a rainy day as a society through owning and holding this SPR, and I think dumping it to sort of pretend like we're balancing the budget as we deficit spend our way into, real other issues. I think is just a huge mistake. And then, the first part of that SPR release in early 2022 made a lot of sense to me going into middle of 2022. But then where there was a substantial increase in that SPR release later into 2022, it became clear it seemed politically motivated. And again, this isn't a partisan thing. It's just, I think it was wrong for Trump to do it. It was wrong for Biden to do it. And it's unfortunate. And we saw a glimpse of what could happen with the energy crisis in 2022, where you saw European natural gas prices go up, what was it, 20x or something like that, to a point where it was just oppressively expensive to even keep lights on or heat on in the winter in places where you needed that. And so I just don't think, it's sort of amazing to me that we've moved so quickly from that sort of extreme where everyone sort of seemed to wake up again to the necessity of having some, emergency supplies of energy and various other things, or COVID, where, toilet paper ran out on shelves. We had moved towards this just-in-time world, and I think there's a lot of cost to that. It's nice to have efficiencies, but I think it's also important to have reserves and to be positioned in a way where you're not shocked. And I think, at the size of the US government and with all the nonsense that we spend money on, having an energy reserve, having some other stuff like that, it does actually seem much more of a public good than many of the things that money is spent on. And I think, from a sort of more libertarian or sort of just classic economic perspective, it does seem like something that's actually really easily economically justifiable versus so many other things that folks support on both sides of the aisle.
Well, I think it doesn't even matter who would be in control of Congress, that they'd want lower oil prices. So if Congress was in control of the Strategic Petroleum Reserve, whether it was Republicans or Democrats, they'd want to manage the oil price as well. Unfortunately, and I think this is both political parties, they really do not seem to be making smart long-term decisions. Everything is so myopic, so short-term oriented with policies. The goal is just to make it out for a couple months, to the next government funding argument where they fight over the budget, or to the next congressional midterm election or presidential election. So every 2 to 4 year cycles. And that just ruins a lot of the smart long-term policies that you were talking about earlier. They're not doing that like they should. It's just compounded now, all these myopic short-term policy goals to try to win elections. And now here we are decades later.
Yeah, yeah. And, I think it's really a tragedy. It's almost sort of like a economic tragedy of the commons, or political tragedy of the commons, where if you look at economic history, and the focus of my studies at University of Chicago was economics with sort of an emphasis on history and econometrics. And so when you look at economic history, the higher your tax rate and the more sort of central regulation and involvement there is in sort of lower level economic decisions, essentially the more centralization there is of the economy, the slower your long-term economic growth trajectory is. I mean, you look at the US, and there's various explanations for this, but it just turns out, as you look at various economies in the world, as you have higher tax rates, which are a good proxy, or at least one proxy for economic activity, for central control of economic activity, the higher your tax rate, the lower your per capita GDP growth rate over a long-term trajectory. And so you look at the US, the economic growth rate per capita was well over 5%. I think it may have been even over 10% before 1900, with no or very low federal income tax. As the federal income tax started to rise and as other taxes started to get imposed, you got into a lower per capita GDP growth number. And then, post World War II, and then especially post early 70s, you got into this on a real basis, much, much lower sort of real per capita GDP growth rate. And so, I think it's really unfortunate because it's not complicated. The joke among economists, I was a think tank analyst in DC for a summer in college. The joke among economists is that if you wake them up at 2 a.m., everyone agrees on the policies. So it's just a question of who's actually paying them. And so, it's really, really unfortunate to see sort of political consensus around observably bad policies. And I'm sure there'll be folks on YouTube and Twitter and whatever will say, "Oh no, they got this wrong because of whatever," and then just look at who's paying them or look at sort of what sort of political thing they're affiliated with, and it's really unfortunate. I think it shouldn't be like a blue team and a red team. It should be a a green team. Let's win. Like, let's earn profits. And the reason why that matters from a humanitarian perspective and is worth spending time talking about on a oil focused economic podcast is that the growth in per capita GDP is the highest. It's the single thing that's most correlated with a reduction of death from starvation of poor people, and it's the basically it's the highest correlated thing with well-being of the poorest people in society. So people have it sort of backwards. They think Marxism is a solution. They think that the government giving them stuff is the solution. And it's actually the opposite. And so it's really unfortunate to see. Unfortunately, this is sort of a bipartisan thing these days in the US and a very popular thing worldwide. And you have these various groups that try to exert control to force things to be more centralized and more authoritarian and so on. And it's really unfortunate because like the people that suffer the most are the people who can afford to suffer additional privations the least.
And also, doesn't for GDP growth, industrialization, the economy growing, isn't that most correlated with energy and electricity usage growth?
Yeah, absolutely. I think it's interesting. You really start to see energy consumption grow. You don't really have much energy consumption, at least formal, outside of just cutting down trees and burning trash and other stuff like that, until you get to about, on a sort of US dollar normalized basis, about $2,000 per capita. Maybe it's 2,500 now with inflation or whatever. Let's say $2,000, and then once you get to like $10,000 of per capita GDP, you start to get into this S curve, they call it, where you just get enormous energy consumption growth, even with very little additional economic growth. It's like the puzzle in China right now. We're actually seeing Chinese energy consumption soar, not necessarily oil. Oil demand in China right now is sort of disappointing, maybe because of electric vehicles, maybe because of various other things, maybe because their real estate sector is collapsing, but their overall energy consumption is actually up. It looks like double digits year over year in aggregate, including solar and wind, all this other stuff.
Didn't China switch a lot of the taxi cabs in some of their tier 1 and tier 2 cities? Didn't they switch to electric vehicles? Didn't they mandate, that's a government requirement? I think they switched a large percentage of their taxi cab fleet to electric vehicles, like the Chinese version of Uber and the government taxi cabs.
Yeah. But China has this issue, which, getting back to the centralization versus decentralization, there was just this news article recently, I think it was from Edmunds, where they were talking about how the majority of Tesla owners have been trading back in their Teslas and buying gasoline powered cars, right? So in America, you still have some freedom to be able to do that. And, they're trying to actually take that away. They're shifting towards fuel mandates that are getting to the point where it's going to sort of force or make totally uneconomic buying gasoline powered cars. But at least for now, people have the choice. And again, there's very burdensome taxes and then huge benefits to the producers of the electric vehicles because of those taxes and credits and whatever. But even with all that, you're still seeing that shift over in the US. You don't see it as much in China because it really is truly authoritarian. And so the question is, you see electric vehicle adoption rising in China, but you don't know whether that's voluntary. And then, that I think in and of itself is sort of a signal. If consumers in the US are choosing to go away from electric vehicles, especially people that were early adopters that chose electric vehicles and are now moving away from them, that I think that tells you about sort of their reliability and efficacy and, what people's preferences are, which is, it seems, predominantly to drive gasoline powered vehicles. And so, I think that'll be really interesting to see it play out over time. There's probably various reasons for people to have that preference. And, I'm not sure that this shift in China so far necessarily means that 5 years from now, this will still be happening. Maybe enough people will have that preference that the Chinese government will, respond, or maybe there's some other efficiency reason or some other reasons why consumers are preferring to switch back to gasoline-powered vehicles, and maybe for those efficiency reasons, they'll be observable to the central planners in China, and maybe you'll see a switch back. So it's a really interesting question, but the reason to bring up China is just even with all their economic troubles, you're still seeing very rapid energy consumption growth. And I do think we're actually going to see a bunch more oil consumption growth in China, maybe not this year, but over time. And it's just because once you get to that sort of base level, one of the ways you make your life radically better is by doing things like, buying a car or scooter or whatever. And some of those are going to be electric and some of those are going to be gasoline powered. And then also putting in air conditioning, a large part of China, along with various other places. It's oppressively hot and in some cases physically unsafe to not have air conditioning in the summer. And then, having much more efficient and safe heat using propane or using electricity or using natural gas for heat in the winter versus burning peat or trash or whatever else people use on sort of the poorest side. And I think that varies in different countries to stay warm in the winter. And there are parts of China that get oppressively cold, bitterly cold for months every year. So it's pretty interesting to see. I think it validates that theory. And fortunately, there's billions of people that are going into that S curve in China and India and various other countries. And so we are seeing this rapid increase in energy consumption that's not tied to AI and not tied to some of these other sort of very popular in the headlines themes right now, that I think will pull oil demand up even more, even with these countervailing trends like electric vehicles.
Exactly. And despite all these environmental regulations in the US and Western countries, the Davos crowd, you have just parabolic electricity demand growth in China and India. You have, I think, coal demand hit an all-time high for electricity generation in 2023, mostly from Asia, China, India, and other Asian countries. Natural gas demand is also soaring. The Indian electricity demand growth is literally going parabolic. It's not just coal. They're investing in nuclear power and natural gas, liquefied natural gas. They're buying whatever types of normal forms of conventional energy or nuclear power that they can get their hands on. I think China and India have the most nuclear power plants under construction by far, too.
Yeah, that sounds right. Yeah, it's really interesting to see. It's really promising. I mean, like these things are tied to people's lives getting better. And then, the really sort of sad thing is you have Davos and various other conferences like that, where you'll have people fly in on their private jets, in some cases coming from their personal giant yachts, where they personally use the same amount of energy as, 1,000 Americans or 100,000 Africans or Indians. And they'll like try to legislate or promote rules that will sort of make that energy more expensive to those desperately poor people that want to make their lives better. And there's this disconnect is so massively hypocritical. And you see it one off, and I'll share it sometimes on social media too. Like the Jeff Bezoses or Mark Zuckerbergs or whatever, with their multi-100-foot yachts and their huge political spending towards kind of constraining energy production. And if you constrain energy production, but you personally use a disproportionate amount of energy, 100 or 1,000 or 10,000 times as much as other people, well, you're essentially starving them of the ability to live like an okay life while you're going and living sort of a really extravagant life. And I'm very for prosperity and people having the ability to do all kinds of things, but I think it's sort of evil to do that while simultaneously starving or choking off the supply of things to the poorest people. And there's different ways to do that. One is to prevent it from getting produced, and the other is to substantially drive up the price, again through suppression of supply and or through substantial taxation and forcing movement from reliable, lower cost supplies to much higher cost and less reliable energy supplies.
Did you see the data that just came out with Google? So Google said that they were going to go net zero for carbon emission, but it just came out in the last, 3 or 4 months that their electricity usage, mostly from fossil fuels and other conventional forms of power, is up 55% in the last couple of years. And that's solely from investing in next generation data centers and artificial intelligence. So while they're on one hand they're promoting those policies that you said, on the other to actually fuel the investments in their next technology cycle and capex, they're actually investing in conventional electricity and using enormous amounts of electricity.
Yeah, I always get back to this conversation I had with a client who has personal money with me with Bison, and but won't put his client money in, and manages billions of dollars for tech entrepreneurs and tech executives and various other folks in California. And he and I sat down, I think it was in early 2021, and he was like, "Hey, look, Josh, like you've done extremely well. And I think you'll do even better when you do something else outside of oil and gas. And at that point, I'll invest client money with you. But aren't you worried that oil's going away?" And so we're sitting down, I think it was in his backyard, and I pointed out that his shoes were made partially out of hydrocarbons, and the fertilizer for the yard was made out of that. There was a plane that flew overhead, pointed out that the jet fuel in it was from oil, and that the plastic in it and whatever was partially from oil. The chairs we were sitting on were essentially plastic composite, or at least wood that was treated with hydrocarbon treatment on the exterior. The exterior of his house was like vinyl siding on top of some sort of fancy wood, or vinyl treatment on top of it. It was just it's amazing, sort of, I think, how out of touch various folks are. And again, brilliant guy, extremely successful, allocated really well across a number of different sectors, and then still just had this basic misunderstanding of what's going on. And again, there's sort of this question of incompetence versus malice, where at Google, do they really know that they were going to be using all of this coal essentially to run their servers? And did they just lie to their ESG regulators and or consultants and in their SEC reports and various other things? But like not intentionally, or was it malice? Like, did they know it was going to happen and just like choose to mislead everyone that their Google searches and the ads and all this other stuff they were doing was supposedly environmentally friendly, when in reality it was sort of horrifically unfriendly and taking up energy that could have gone towards like air conditioning in India to help keep people alive longer and have them not die from heat stroke or something like that. So again, it's sort of, I don't know what the answer is there. And I think, it merits reporting, which of course is not done, unfortunately. But, there's just this tilt towards these sorts of things and being totally uncritical of them, unfortunately, in our society, including in the media. And I think it's worth talking about. It's worth thinking about in terms of that. And if Google can't do it with their massive profits as one of the biggest, most profitable companies in the world, how do they expect the rest of us to do it? And why are those founders and senior executives funding these political initiatives to try to suppress energy supplies of the stuff they're using? Right? It's like this very weird interconnected thing that seems very out of touch. And again, do they not understand it, or do they understand it? I'm not sure which is worse.
Well, they're going to start to figure this out, and we're starting to see articles on this, Josh, the last 6 to 10 months, because the next generation data centers that are planned, they haven't started building a lot of them yet, but over the next couple of years, these things are going to use potentially an order of magnitude more electricity for artificial intelligence, for chat GPT searches. That uses up way more electricity than a normal Google or internet browser search. So the next generation data centers are going to use even more water, even more electricity than the current data centers that we have now, that mostly focus on bandwidth and latency for things like Netflix and YouTube.
Yeah, so I actually looked into, so when I was chairman of a Canadian E&P, we were losing money on our natural gas and making money on our oil. And I looked into and actually started ramping up Bitcoin mining using our natural gas, our excess natural gas, and our excess sort of power generation that we had on site for our drilling operations. And so I actually looked into leveraging that background, looked into starting some smaller, essentially like hosting for data warehouses and for essentially like AI type computer centers. And it was really interesting to look into sort of what's actually happening. So one, the scale of these things is so enormous that it didn't really make sense to try to enter that space as a new entrant on the smaller side, because there's just enormous sort of it's not exactly economies of scale because they're not cheaper as they get bigger. They're just, I think, more effective if more of the computers are in there, more of the chips or whatever in like the same space. Again, this is sort of, I'm not an expert on it, but this is sort of what the people that are experts on this were telling me. And then the thing that is wild that I think people don't understand that's going to drive, I think, an order of magnitude more energy consumption for AI than people are thinking, unless it's solved. But it seems like the solution, and more as I talk to people, I'm hearing more and more about this, which I think makes me comfortable to actually talk about it. The solution to hallucination, which is basically when you ask chat GPT something, it's often wrong. And sometimes it's increasingly wrong on the things you ask it. So, you don't want to like rely on it for analytics or various other things that you need that are mission critical because they're often wrong. So what companies will do that are trying to use AI to and use these LLMs to get an answer that is reliable is they'll basically run the same query through multiple different LLMs, whether it's their own or whether it's ChatGPT or the Google one or the Microsoft one or the various other whatever. There's like a number of them out there at this point, and there's others. I can't even remember. There's one that starts with a P that's like very popular, and they and then they have there's this software that various folks have built where they'll basically run everything. So instead of doing it once, right, which again is like enormously energy intensive because you're basically doing 100 equivalent parallel processes, and the chips are doing way, way, way more interesting things than just sort of a normal program or even a normal algorithm. But then they actually will run these things essentially like 10 times through a bunch of different programs and then have another AI program, or maybe it's not AI, maybe it's just machine learning running, comparing the outputs to try to figure out when there's hallucination. So apparently, like to actually get a usable output, it might actually take running the equivalent of 5 or 10 queries through ChatGPT equivalent. And so, all the numbers on energy, it's all too high in terms of how quickly these AI data centers are going to come on and how much they're going to use, but it's also too low in terms of how much they actually want to use. And the people that know it best keep talking about how the constraint on all this is going to be energy. And everyone's like, oh, well, the chips are getting more efficient. And the reality is that as it gets bigger, the other equivalent, I think, is like if you think about your phone, right? I still have 128 gigabytes or whatever of storage on my phone, and then I put more stuff up on the cloud, and I never have enough storage because even though 128 gigabytes is a lot, it's way less than it was, let's say, 5 years ago. But like picture sizes are 10 times bigger. Are they 10 times better? Definitely not, but they're 10 times bigger. There's just sort of this like size creep on all kinds of stuff. And it seems like that's already happening a lot in AI. And I apologize to everyone if somehow this ends up totally misunderstanding or mischaracterizing it, except the folks I've talked to that are building AI related businesses or are at some of these bigger companies that build or run some of these models. They are seeing this themselves, and in many cases, they're actually sort of, what is it called, hitting the bid. They're basically like anywhere where they're able to get a large data center development site, they're just taking it. Like even if it's expensive, they're just buying it or contracting it and getting the option to be able to buy it or so on. So I don't think I'm wrong on this, but it's not the thing I'm expert in. But when you hear enough people that are expert in it talking about it, at least on the current trajectory, you might actually need way more of these data centers and way more energy, even with more efficient chips, just because of the nature of this thing that I think people, at least outside of it, don't understand. Like the idea of having to run everything through a dozen times or even 5 times to get a usable answer. It just obviously you need 5 times more of it if you're going to have to do that.
And I think the energy companies, the utility companies, nuclear power, natural gas pipeline companies, they're going to be the beneficiaries of all this capital expenditure Amazon and Microsoft and Google and Meta and NVIDIA may even chip in on that project between OpenAI and Microsoft, the $100 billion 5 gigawatt data center that's supposed to be built by 2030. So I could see energy being a main beneficiary of that. I want to get your thoughts, though, on the enormous amount of mergers and acquisitions the last 18 months in the oil and natural gas industry. There's over $230 billion worth of acquisitions. We just had the Pioneer Natural Resources acquisition go through in the last couple of months. ConocoPhillips just made a large bid on Marathon Oil. It looked like the shares of Marathon Oil, someone already knew that Marathon was going to get bid up months before that actually happened. And a lot of the independent companies, the mid-tier ones, are making bids on smaller assets. Do you think that this is because the valuations are super cheap on the companies being acquired, or do you think it's for growth or reserve replacement?
All of the above. Actually, some of these deals, some of the biggest deals, actually don't seem that cheap. And so I don't really understand the economic logic of, let's say, Exxon buying Pioneer. Or I understand why Conoco bought Marathon. That makes sense to me. And some of the other stuff sort of makes sense, but the Exxon Pioneer deal, I mean, the valuation for Pioneer was really high, and it was technically slightly accretive for Exxon, but Pioneer is just an upstream oil and gas producer in an area that at this point is very well understood and pretty heavily developed. Whereas Exxon has these integrated operations and owns pipelines and refineries and chemical plants and oil trading and all kinds of global logistics stuff around the oil industry. And so, it seems like sort of a mistake similar to when Exxon bought XTO more than a decade ago, or when they bought Inner Oil off in Papua New Guinea. Exxon has made very large purchases that I didn't understand at the time or thought they were dumb, and they've ended up writing down. I think they wrote down Inner Oil for 100% of the purchase price. That was, I think, a $7 billion deal. And XTO, I think they also took tens of billions of dollars of write downs on. So I wouldn't be surprised if Exxon has to write down a decent portion of that value for Pioneer. But some of the smaller ones, definitely, it's sort of all of the above. It's reserve replacement, it's economic, it's accretive, and so on. But then even on the services side, you're seeing some deals like you saw H&P, Helmerich and Payne buying KCA Deutag for $2 billion recently. And that, to me, I think that's worth talking about just for a second, because H&P is sort of the number one US shale drilling rig provider, and they offer a really standardized product that's considered, if you think about sort of the consulting framework, which is sort of where I started my career, you either, the two winning strategies as a business are either being the premium provider of a thing and getting to charge a premium price for it, or being sort of the low cost provider of the thing and being able to make it up essentially on volume. Those are sort of the two winning strategies, and you want to be sort of the number one or number two provider of whatever good or service it is in your market. And so H&P went from that in the US, which has been an enormously profitable business, and they've been very successful at it for a long time. And they went and bought this international drilling rig business that is not, I was actually not that familiar with it ahead of their deal, but it's fine. It's not the world's biggest drilling rig company. It's not necessarily the best drilling rig company. They're in very competitive markets. They're active in the Middle East and elsewhere. And they actually paid a higher multiple than they trade at. I'm not involved in either security. I'm not recommending this or anything else I mentioned or whatever, but it's just very interesting to see. And I think that might actually be a signal of shale maturation, much more so than, looking at sort of well productivity or other stuff like that. Like, these guys would really know because they can look at their customers' drilling plans, and they provide services to most of the largest E&Ps and other similar companies here in the US. And so, them going and paying a premium valuation to buy an international company that isn't as standardized as they are and doesn't sort of fit this, number one provider of service in their category and their geography at this premium price, like H&P in the US, I think it's very interesting. Almost no one's really talking about that and sort of tying it into this sort of bigger picture shale issue and what it means for the global oil market. And I think it's worth people looking at it, and it's worth thinking about the implications of this. They say, what do they say? There's no bell at the top of the market or whatever, but this could be an alarm bell for shale in terms of what's coming. Maybe not in the next months, but I think maybe over a multi-year period.
Do you agree with Christine Guerrero that basically U.S. shale oil production is more or less in a treadmill now, that more and more CapEx has to be spent just to prevent production from collapsing?
Yeah. Christine's really smart. I think she's right on that. I think the one complexity there is that production has stabilized with the rig count down, which is not something that I thought, or as I recall, she thought, or various others thought. And I was essentially wrong. I thought that, well, not essentially, I was wrong. I thought that the U.S. Oil shale production number would have fallen substantially with the rig count having fallen as much as it did over the last 2 years, and I was wrong. It hasn't, and so there are some improvements in well productivity, or at least reduction in degradation trajectory that I did not expect and that were not sort of part of the consensus expectations. And I think the question is, how sustainable are they, and sort of what's going to happen next. And I think this H&P deal is maybe an indicator that some of these changes have been they've been sort of temporary, and it's sort of kicked the can down the road a little, but not a lot. And that, as the rig count comes back up, despite high grading, despite longer laterals, despite up spacing, this degrading core inventory is going to drive eventually much higher investment requirement to sustain production, which should lead to many more rigs being used, which again makes it so interesting that H&P would choose at this point to go spend a bunch of cash to buy an international rig company. I think it's just such an interesting question, and so I think it's directly relevant for that question in terms of what's happening with shale when the largest service provider to shale rings the bell and goes and buys something with cash internationally. You really have to step back and think about it and reevaluate your assumptions and analysis.
And also, a lot of each of the wells, the percentage of natural gas and natural gas liquids is increasing. So if you go back and look up how much percentage of natural gas liquids and natural gas are from the wells drilled, I mean, that seems to be trending up a lot. As Christina said, Christine Guerrero has said this, that the trend is that more of each well drilled has more and more natural gas liquids, and less oil.
I think that's been the general trajectory. But again, there's just more oil production now than I think many people would have expected, given what's happened with the rig count, which again requires a reevaluation of what's happened so far. And I think the biggest thing really is just upspacing. Is a way you essentially don't put your wells as tightly together, which allows for more production per well, but allows for fewer wells per acre. And so if you have a limited number of acres that are the best for producing oil out of, then you just cut into that. So if you had 5 years of core inventory before, maybe now you have 4 plus however many you've depleted from the passage of time. So that's been interesting to see. And, I think partly that's reflective of lower oil prices and very low local natural gas prices in West Texas and Southeast New Mexico in particular. And so I think that's been driving, it's been essentially forcing companies that are trying to earn a profit by drilling these wells to cut into their core inventory, and then spend more per well to try to maintain their high production per well. So it's this balance, and again, complicated situation, but I do think that it's sort of accelerating the decline in core inventory, and it sort of has pushed it's pushed the problem down the road a little, but the problem at the point where it becomes more of a problem, it's going to be a lot bigger and require even more rigs, even more fracking crews, even more additional equipment and pipes and various other things. And so I think there's sort of another sort of shale crisis looming, and it's just a question of, hey, does that happen in a year or 6 months or 2 years or 3 years? And so again, it looks like H&P is getting ready for it, but it seems like getting ready for it by going and buying international rigs and maybe expecting a pickup in activity there versus expecting a huge pickup in activity here. And again, in their defense, they have a lot of rigs here that aren't working currently, so they would be a beneficiary anyway, to the extent that what I just described ended up playing out.
I mean, diversification is probably smart long term. So rather than continuing to bet on one area, some diversification is probably smarter. You've talked in past interviews that it would have been more efficient for ExxonMobil to go and buy smaller oil and natural gas companies in the Permian Basin that were selling at cheaper valuations. Do you think that the Canadian oil and gas sector, with the mergers and acquisitions lately, is being more efficient with M&A than a larger company like ExxonMobil?
Um, I mean, they're just different markets. And so in different markets, you're going to have different valuations, both driven by different well economics and sort of inventory availability, as well as by other factors. And so I don't know, there have been some weird deals that I haven't liked. And then there have been some deals that were so incredibly compelling that it invited questions as to why why they happened and why there wasn't someone that paid a higher price for them. And so, I think the Canadian market is it's always sort of been a little funky. And, there's been a pretty wide dispersion in transaction valuations in Canada. So there have been deals at high prices and low prices, and, ones I think that have been too expensive and ones that have been too cheap. So, I don't know if it's a Canada versus US thing, but I would stick by what I said. And I think it's interesting. One recent deal, SM Energy bought was it XCL, this Utah-focused Uinta Basin producer, and nearly paid about 3.5 times cash flow for it. And it looked like the inventory on that asset was looked like there was about 10 years of inventory that they claimed, and then maybe upside to another 10 years if they delineated a bunch more stuff. And so when you look at that at 3.5 times, and again, it's not nearly as big as Pioneer, but if you can go buy 10 of those, why on earth at 3.5 times each? Maybe if you're Exxon, you had to outbid SMs. Maybe you have to pay like 4 times. If you could have bought 10 of those at 4 times EBITDA versus paying 6.5 or 7 times for Pioneer, I think it's a real question in terms of why they chose to do that and how much of that is just sort of corporate entropy or inertia, where they just sort of keep going with what they have, and then it's so hard to do a deal that they want to do as big a deal as possible. But I think when you pay a really high valuation for something, especially when it's pretty mature, I think you have a lot of risk of getting in trouble with it, and relatively low upside from the risk that you're taking. So yeah, I still think that's the case. And frankly, even if they were just buying in the Permian, I think there was a good set of deals that have happened since then that have been at lower valuations with sort of a combined inventory set that would have allowed for comparably high returns on comparably large inventory that could have been purchased at a substantially lower price, both on a production basis, which is essentially that sort of cash flow metric, measured differently, but essentially one is a proxy sort of for the other, as well as for undeveloped inventory. So if you can have comparably high returns and a similar amount of production and pay half as much for it, you should make, twice as much money gross, but net you make way more profit, because again, like a high entry cost can be calamitous for actually earning a total return net of all costs on a purchase.
Especially if their track record is, like you said, writing down a lot of these past acquisitions where they go to make larger ones for a headline splash. You do not see the mainstream financial media talking about how ExxonMobil has written off those deals. Like you said, I don't think I've ever heard that before. It's always like, oh, the next deal. Oh, they're going to go and buy, what is it, Hess Oil. Oh, they're going to go to Guyana and buy that or exercise a clause. So the mainstream media is always congratulating them for those large deals. They don't follow up and check, like you said, later to see that they wrote down so much of the deal later on.
I mean, in their defense, I think it's true. I didn't see a lot of discussion recently around these deals about their losses on past deals, but when they did those write downs, there were news articles about it. But it was sort of weird because they sort of conflated the write downs by Exxon and Chevron and Shell and so on and BP. They sort of conflated that with the end of the oil age, which was, I think, a misinterpretation.
That's just political spin. Yeah.
Yeah, but it's just like, just because BP loses money on an acquisition or Exxon loses money on an acquisition doesn't mean oil's going away. It just means they overpaid for it, right? These are not like, I
Yeah.
occasionally, I'll buy a company and the stock goes down. That's not, it's my fault. And, it's the company's fault if they mismanage it or whatever, but, it's my fault. It's not like the world's fault. It's my fault. So, it's Exxon's fault that they lost money on XTO and Exxon's fault that they bought that Inner Oil, even though, there were a number of different reports showing that they probably didn't have the resources that they were claiming to have. Or, BP like selling core Permian assets after Macondo and then coming back in and buying pretty junky tier two Permian assets from BHP years later at a very high price. It was sort of weird. They sold great Permian assets at a very low valuation and then paid a higher valuation to get into lower quality assets in that same area and then had write downs.
Well, their capital allocation for BP is absolutely terrible. They wrote down Russian assets too that were confiscated a couple of years ago or potentially confiscated. They wrote those down, and then they lost tens of billions of dollars because you have activist investors joining the board now trying to get BP to stop investing in wind, solar, biofuels because all their ESG investments. I mean, the losses are just absolutely enormous.
It's pretty amazing, and sort of there's this joke that the most certain way to make money in oil and gas is to sell assets to oil majors and then to buy assets from oil majors. And so, it's sort of this weird thing. You'd think that it wouldn't be available, but repeatedly throughout cycles, you see this happen. It's not any one individual, one of these companies. It's sort of in aggregate. They do seem to destroy value on both directions. And so, it's one of these weird things. Talking about this with some oil execs I was having dinner with last night, and we were talking about why certain deals go off at certain prices. So one of the CEOs, his buddy, was selling Delaware Basin assets in, I think it was early on in that sort of boom. So I think it was in 2017. And they were thinking they were going to go sell it for like $10,000 an acre. And their financial advisor told them to just ask for 40,000 an acre. And the buyer said yes. And so they weren't even going to like ask for that. And so it ended up being hundreds of millions of dollars more for them and this sort of wonderful win. And the reality is that, the buyer was this big organization that wasn't really carefully underwriting the thing. And a lot of it was just sort of, putting out that price first. And, I think tying that back to this, I think Pioneer got bought for a high price, partly because they were trading at a high valuation. And some of these smaller producers trade at very low prices. And I think people just look at the stock prices and just figure that the market has it right and is efficiently pricing these things when there are various factors driving their prices. But it seems actually sort of infrequently on the smaller cap side of any sort of company these days with how fund flows have gone. But particularly in oil and gas, the current market price for a company doesn't actually seem to be a great proxy for its intrinsic value. So it's sort of odd and interesting to see assets transact that are very similar to other public companies on returns, on production, and so on. And see one trade at 3 times cash flow and another transact at 6.5 times cash flow. And so, yeah, not to be too negative about the oil majors, but you look at just sort of this set of transactions, U.S., Canada, elsewhere, and it's just there was this one Canadian company that bought, I think, a European gas asset, and the stock almost doubled in 2 days on their transaction because they did such a good deal. And I think the seller was an oil major. I don't remember which one. So that's an example of sort of where you can see sometimes the public market will reflect these values pretty quickly if it's extreme enough. But anyway, there is this real big disconnect between sort of transaction value and intrinsic value, and sometimes market value in both directions.
And there's opportunities there for distressed asset investors, the royalty companies like Franco-Nevada, which normally deals with gold royalties or gold streams, but they were aggressively buying. I think Harold Hamm, who was involved, if I remember correctly, in some type of divorce, like his lawyers were forcing him to liquidate some of his assets, and he sold a large amount of the royalties he owned in the shale patch for Continental Resources. He sold them for cash to Franco-Nevada, and then Franco-Nevada back in November of 2023. So not that long ago, they went in and bought discounted distressed assets from producers for Haynesville natural gas shale at a substantial discount. So the valuations can change. I mean, it's not objective. Like you said, I mean, the market seems to overvalue a lot of the oil majors assets versus the smaller ones. I want to get your thoughts though on this Canadian pipeline that's coming online. So you were telling me before we started talking over the last couple of days, this Canadian pipeline, it's been under construction for a very, very long time. Who do you think will benefit from this pipeline actually coming online and allowing for more oil to be moved from, say, Alberta to the coast?
But before we talk about that, just real funny that you mentioned Franco-Nevada. So one of the other folks who was at dinner last night, he bought some Haynesville royalties and then sold them to someone else, who I think sold them to someone else, who then sold them to Franco-Nevada. And I think between the price he paid for them and then the price that Franco-Nevada ended up paying, I think there was sort of an 8x multiple increase in price from what he was able to pay on the ground leasing as like a primary, buyer of these minerals from whomever owned them for 100 years or whatever to the price that Franco-Nevada ended up getting. And that's not to say that they won't make money on that, but it is sort of, talking about big versus small and high valuation versus low and distressed versus not. It is pretty amazing in terms of how different those valuations can be. And frankly, my friend, like, he did well, but I was bugging him not to sell, and they sold anyway. And then the guys that bought from them resold for like 3 times the price of my buddies. So he got like a double, and they got like a triple. And then Franco-Nevada ended up with those assets after all of that. So for better or for worse, that's sort of how it seems like these assets go. In terms of the Canadian pipeline, yeah, I mean Trans Mountain, along with Keystone, I mean, they've been just tremendous disappointments, and it's taken forever for them to come on. And heavy oil prices repeatedly crashed in Canada as their government sort of failed them. Again, this isn't even like a political party thing. Harper was terrible at getting pipelines on. Trudeau's been worse. It's the Liberal Party and the Conservative Party. They just, you sort of need the government to get out of your way to some extent to be able to be effective in a competitive industry. And oil and gas is a globally competitive industry. And so, the Trans Mountain Pipeline now is on, which is good. And heavy oil prices are recovering to some extent. But the local producers, I've had this complaint publicly about natural gas, where the producers are sort of uneconomically, aggressively, essentially dumping gas into the market, both in the US and Canada, and crashing the local price. Partly, I think, to be able to go buy more assets at a low price, and partly it's sort of like the scorpion and the frog. Scorpion gets on the frog, they're halfway across the river, and the scorpion stings the frog, and they both die. And so, they just can't help themselves. So anyway, the heavy oil producers in Canada are back at it, growing their production, on track to potentially fill and exceed the capacity of this expanded pipe in the next few years. So there's more to this story than people are saying. And these guys just can't seem to accept a good thing and enjoy it. They're in the process already of preparing to destroy it in the next few years.
Okay, so this pipeline, is it going to remove the discount of Western Canadian Select? So that's a heavy sour crude. Is the discount that was what, 15, at one point it was $15 a barrel discount. As this pipeline increases capacity, are the sellers of that oil, are they going to be able to get a much higher market price going forward?
No, so at one point that discount was $50 a barrel in 2018. And so one of the things the pipeline does for now is it reduces the odds of that sort of extreme basis blowout like we saw in 2018. And then also in 2020, there was a discount for heavy oil, even in addition to the very low price for just WTI and Brent oil. And so you're going to have tighter differentials for now, and you're already seeing substantially better price realizations for these heavy producers in Canada. But again, it's wonderful for now, and it's sort of this situation of too much of a good thing. And if you just look at the announced plans or some of the projects that are in place, you're already seeing a path towards substantially more heavy oil production in Canada across a number of different producers. And given how hard it was to get this one pipeline extension in, I think it raises real questions about what the long-term differentials will be. So again, this isn't what you're going to hear from anyone else. Everyone's so excited about how the pipeline's on, and prices are the differentials lower, so prices should be higher, and not blow out, at least for a few years. But I just think it makes sense to understand that, enjoy it with companies that benefit from it, but also sort of keep my eye on the next ball and where the puck's going, or whatever your favorite aphorism. And I think in this case it makes sense to remember that there isn't unlimited capacity on this thing, and to look at which projects are on or coming on right now, and then which projects may be coming on over the next few years and or are already underway. And so again, it's good. It's frankly been great. Some of the heavy oil producers have traded up a lot. Some of them have not yet, which is very exciting. And it's one of those things where I can both be maybe negative on Canadian basis, let's say 5 to 10 years out, and very positive on companies that have materially lagged their peers who are beneficiaries of this uplift in price. So anyway, that's sort of my take on it. I think it is wonderful for the country. Hopefully they see all this extra revenue and all this extra tax revenue and royalty revenue to the government, as well as extra jobs, and they go and sanction another pipeline expansion, or try to get Keystone XL up and running or whatever. And unfortunately, the reality is that that's just not how energy policy is done in Canada. And so unfortunately, with sort of the trajectory of the producers today, in response to these much tighter differentials, along with these sort of failing and sort of bad planning policies, I think you're going to end up with worse oil pricing for heavy oil in Canada, let's say 5 years out from now.
That's very interesting. You told me that pipeline took over 10 years to build. So it went through multiple administrations. So both administrations are to blame for all the delays, rules, regulations, cost overruns, all the things involved in that. So you would say then that overall, once this pipeline is up and running online, or whatever increases they have, that profit margins and free cash flow for these Canadian oil producers, they're not going to be overall trending higher. You think that there will be overproduction, and there will be problems with profit margins and free cash flow? Then there won't be the free cash flow growth from the differential from the discount. The oil won't be discounted, and that won't boost profit margins and free cash flow.
No. So it's already on, and so it's already boosted margins and free cash flow for the businesses that are for the producers that are supplying it. I was just sharing sort of what I think happens next, which is there's this period where these producers are already enjoying these higher margins, and they enjoy them so much that they're going and drilling more SAGD wells, and they're expanding mining operations, and they're drilling more cold flow heavy oil, and they're just
okay. So marginal stuff. So you're just going through the details. Those are marginal projects that are high capex and not as good as what they have now.
Yeah, but what makes it worse is that they've just experienced these high differentials, low realized price for many years, and they are actively moving towards enough production growth looking forward a few years from now. And again, it's sort of uncertain exactly when which projects will come on. And some of them have just been announced and haven't gotten started. Some of them are going to take a few years, whatever. But sort of in aggregate, there is this benefit, and it's wonderful. And it's maybe too good, because too many of these producers, they don't seem to have found religion from a capital discipline perspective. And they're failing, similar to how the gas producers, both in the US and Canada, are failing the sort of their game theory 101 exams. The heavy oil producers in Canada seem set to fail their game theory exam as you look at their activity and their production trajectory versus this relatively limited incremental space on the pipes. So great for them right now. They're showing production growth. The shareholders are happy. Some of the producers that just produce heavy oil see their stocks way higher. Some of the producers that have sort of this mix of oil and gas and NGL and whatever production haven't traded up nearly as much. Those, I think, will sort of catch up with their sort of pure play heavy oil producer peers as they go through this period of excess profits, essentially. But then, like all good things, well, some good things in the oil and gas industry, this one may come to an end to the extent that they continue to sanction new projects or expansions and go towards filling it. So this is something we put out our white paper on this in early 2021, 21, where we said, hey, things are going to get a lot better for Western Canadian producers at a time where these share prices were way, way lower and where people didn't have this expectation of dramatically improved margins and price realizations. And I guess what I'm saying is, let's say we have this conversation 5 years from now, my expectation would be there's a much higher chance than seems to be priced in that it's going to be a sad tale of much higher discounts for this oil than I think people are expecting.
Also, what you just mentioned in some of the details, it sounds like management teams are not disciplined with capital allocation. They're not focusing on maintaining profit margins and free cash flow, or maybe going and buying discounted assets. Looks like they're starting to invest in those marginal projects, hoping for a rally in oil prices. But if they invest in those marginal oil projects and they don't get higher oil prices, they're going to destroy their margins and their costs are going to rise. So they're not going to have the profit margins and free cash flow that they're anticipating.
Exactly. And the basis for that is one, noticing how much heavy oil production has already grown in the last year. Two, noticing the plans for it. And then three, noticing what's happened, this just absolute dumpster fire that's happened with natural gas in the last couple of years, where you've seen production substantially higher now versus 2 years ago, and production close to flat year over year for natural gas, despite price levels that are below break evens, at least on the dry gas side, for most dry gas producers, both in the US and Canada. And so when you look at that and you compare it to the narrative of, oh, hey, the industry found religion from not overproducing and, figuring things out from a game theoretic perspective of, it's not just you like optimizing for your own problem. It's trying to optimize for not oversupplying the broader market. And obviously, like, you can't do that formally or through communication because that would be sort of price manipulation or whatever. But you can solve that on your own, and from a game theoretic perspective, figure out sort of what the right amount of production is to come on. And unfortunately, the natural gas producers are feeling that pretty badly right now, both in the US and Canada. And so that's, I think, a reason to be worried about the heavy oil. But again, not something that I think is so pressing right this second, but I think it's worth putting it on people's radars just because, hey, this narrative is sort of overwhelmingly positive. And, I think there's still this catch-up trade, which is going to be, I think, pretty spectacular. But I think once that catch-up trade, just like the heavy oil companies, traded phenomenally well over the last couple of years as people started to price in the pipe coming on. And then once it turned on, I think some of the sort of mixed producers, as that higher price rolls through their financials, may surprise people to the upside and then, may trade up even more. And at that point, that's probably my exit signal to move on to greener pastures than Canadian heavy oil.
And it sounds like there's a huge natural gas glut both in the US and Canada, and the producers of that natural gas, they need to figure out deals with the pipeline companies to get the gas moved to either a utility company, or like Journey Energy, they build an electrical utility company efficiently, they restart one, or EQT's building a natural gas pipeline down here to Northern Virginia, or they want to, at least from the Marcellus and Utica Shale. So these next generation data centers that are going to start construction, they're going to use even more natural gas. So there needs to be pipeline infrastructure for natural gas. My last question here before I let you go, a lot of my listeners are retirees. They're looking around. They're worried about the market conditions right now with the macro environment, whether or not the Fed cuts rates more soon, all the problems in the global economy. They're looking for safe dividends. Do you think that the oil and natural gas industry right now are the free cash flows sustainable? Can they be grown? And do you think that this industry will be one of the leaders for dividend growth going forward?
That's a great question. I mean, I'm not a personal financial advisor. I run a fund and focus on just, sort of trying to maximize the risk adjusted returns for the fund over time while focusing in the oil and gas space. So it's a little bit of a different question that I spend my time thinking about professionally. But yeah, I think there are some companies that should have pretty reasonable dividends over time. And there's probably a way to solve for sort of the riskiness versus the dividend payouts. But I think the highest returns on those are probably from buying in periods of panic rather than buying in periods of relative stability. And so I think it makes sense to own some of these things with some portion of a portfolio, and everyone should consult their own advisors and so on to figure out what that is and whatever. But what I have found personally is buying oil and gas yield oriented companies when they cut their dividends or when people are worried about it, and then benefiting when they restart dividends or when people are less worried about them getting cut, has been far more profitable than where I've just bought stocks that pay dividends and just hold them. So I think there's a reasonable expectation of volatility going forward, both for oil and gas and the broader market. And I would, if I were trying to get income from dividend paying oil and gas companies, I would wait for a period of panic and buy aggressively when everyone else is really scared. And right now I'm finding that sort of equivalent in these sort of smaller producers that aren't really dividend payers that are trading at just ridiculously low valuations in my assessment. But I'm not seeing that same sort of discount or same sort of panic on the dividend payer side. And then the buyback companies, many of them have actually traded to significant premiums. There's one that's very proud of doing buybacks, but it trades at a premium to its net asset value. So it's sort of odd. They're like propping their stock price up through buybacks, but I think they're actually destroying value with every dollar they're spending on buybacks. So anyway, you didn't ask about that, but I think it's a good question. It's a complicated question. I think people should be careful to not get lulled into complacency or safety, perceived safety, through relatively stable recent share prices and recent dividends in a sector that's very cyclical. And even though I'm very bullish on oil, I still would expect there would be periods of panic as well as periods of exuberance. And, even for things that would be multi-year holds, there may be better opportunities than today to get entry points into stuff to hold for a long time for dividends. But again, they should consult their own advisors and figure that out for themselves.
And you mentioned buying contrarian panic investing kind of with discounted valuations and blood in the streets where the company cut the dividends. I mean, I would imagine at this point with natural gas prices, we had a rally in natural gas prices 6 to 8 months ago. Now here we are back down enormously. I would imagine that a lot of the US and Canadian natural gas producers that are more than 50% natural gas oriented, they're starting to panic now because those hedges that they had in place over the last couple of years, those things are going to roll off. They're going to have to start cutting production soon. We're getting way below the production cost for natural gas. So I think there's going to be panic soon in the natural gas producer space.
You would think that, except some of their earnings have come out. And if you define panic as, hey, we're going to grow our production more, then that's panic, at least for the few big ones that have reported so far. So again,
are
very
those
disappointing.
hedges? Are those profits you're saying, are those because of hedges then that they hedged at what for?
Yeah, but they seem to be like really bad at math, because you'll have these companies that have some hedges, and it's just remarkable. It's just remarkable in terms of how poorly they seem to be able to do math. Right? If you're 30% hedged, and you're losing money on all the rest of your production, you should constrain some of your production and then maybe monetize your hedges and then maybe drill a little less. And instead, their answer is just drill, baby, drill. And I think that's like a very poor decision from an economic perspective. And I think it sets up very poorly for the industry broadly. And it's economically unhealthy and sort of wasteful. And so, I'd like to think that over time, the industry would move towards sort of more rational behavior, but unfortunately that hasn't happened. And even COVID wasn't enough to really, and ultra low prices for a while didn't seem to be enough to really get the industry to find religion from a capital expenditure perspective. I need to run though. So thank you very much for having me on. It was great to get to chat with you.
Excellent. Yeah, it sounds like your dog needs a walk. So thank you very much for your time. And I'll attach a link to Bison Interests website. My listeners for free can sign up for your newsletter tracking the oil and natural gas industry.